Welcome back to the Beat the Odds Business and Wealth podcast. We got Alana here running the switcher here today. And Trevor, where are you at today, Trevor?
I am in Salt Lake City, Utah. And yeah, it's been great. Beautiful weather here. We're at the Church of Jesus Christ of Latter-day Saints Capitol. Been seeing some interesting sites around here. So yeah, it's a bigger city than I thought it was going to be. If you look on Google, it says only 250,000 people here, but I think that's just within Salt Lake City. But yeah, great city, great place, wonderful accommodations. And after today, we're starting our trek back to Canada.
Right on. Well, that's all nice and dandy. So now let's get to the real stuff of how CRA wants to steal the equity in your house and how they're going to do it and the excuses that they're going to use. So that's what we're talking about today. So people are prepared for what's coming. I've been saying this for a while, that the target is real estate. It's the easiest target out there. It's immovable. It's easy to find. They understand the transactions. And when I give you a glimpse into the absurdity of how they, start taxing what is supposedly a tax-free disposition of principal residences, it's going to open a lot of people's eyes. Because it's happening on a more frequent basis at this point. And I think people will be shocked. They will be absolutely shocked when they see the reasons of why they would do it. Okay. So I want to get into it here. What I'm going to do is I'm actually going to share something with you guys here. And I've redacted this, but this is not like, I think they might see some other things that are like little clickbaity on the internet and things like that. This is an actual audit file from CRA. I'm going through. I've redacted all of the the client specific stuff in there, but I want to show you the reasons that they're using, the 12 criteria that they're using. First of all, it's kind of interesting. The entire sentence, they don't even make sense in their sentence. There's no provision in the Income Tax Act which describes the circumstances which gains from the sale of real estate are determined to be either income or, and then it just goes into a list. They don't finish that rest of that sentence. But 75,000 employees, they can't proofread the document. But and they're gonna assess you tax based on this document on the largest transaction of your life. So let's go through the criteria that they're starting to evaluate people, with more frequency on the sales of principal residences. Okay, so I have this document here, just so people know. This is what I'm reading it from. It's an actual audit file that from a client file that we're using redacted, but this is the standard criteria that they're looking at. So okay, we can break away from that screen, Alana, but I have this here for our resources here. So let's go back to the first one is the taxpayer's intention with respect to the real estate at the time of its purchase. So CRA wants to tell you what was the intention in your head at the time that you made the purchase of this real estate. So someone is going to send you a document asking you, what you purchased this property for. They're going to say how much you paid for it. What do you do for a living? What did you put into this property? And they're going to tell you what was the intention in your head at the time that you purchased it. But you know what they're not going to ask you in the document request is they're not going to ask you what your intention was at the time that you purchase it. They don't even ask that question on the information submission that they're doing. Okay. And Trevor, like when people come to you for mortgages, is like, do you think they're really thinking about they're going to pay tax on the disposition of their principal residence someday?
Heck no. Let's be real. Like most of our economy in Canada is based on us trading real estate back and forth to each other. Having your principal residence protected from taxes, kind of one of the only things that we've been able to rely on for kind of accumulating wealth in the past number of decades in Canada. So when people come to me for a mortgage, they're not thinking that if I make a gain on this property as my principal residence, that I'm going to be taxed on the sale of it.
Yeah. I mean, but CRA is going to tell you that your intention was to sell it for, your intention was to trade it right away. So now The next one is the feasibility of the taxpayer's intention. So that intention that they didn't ask you about, now they're going to tell you if that intention was feasible or not. So imagine you qualify, using 39% of your income, maybe you get a cosigner or something like that, and then you lose your job. And now this real estate that you purchase is no longer feasible to hold. So once it becomes no longer feasible to hold, well, was it ever feasible? You know what I mean? Was it ever feasible? And what exactly does that mean? Was it ever feasible, right? Obviously it was feasible. Like, we have some of the most stringent mortgage qualification criteria in the world. So to say that it wasn't feasible at the time of purchase, that's interesting. Okay. The next one would be the geographical location and zoned use of the real estate required. So let me get this straight. So if you buy a house in a place that has a history of making money, maybe that precludes you from using your principal residence exemption, the geography of where you buy it, okay? Or any ambiguity in the zoning of the property. So if you have a property that's zoned for dual uses or more than one use, even if you're not using that use at that time, they could say you had the ability, and that was the ability to sell your, to tax your principal residence gain, okay? And then it's the extent to which the intention is carried out by the taxpayer. Again, the intention that they never actually ask you in the first audit submission. They won't actually ask you about the intent at that time, okay? But they're gonna grade you on the extent that you carried out that intention, as if things don't change in life circumstances where people, they get married, they have kids, they get divorced, they die, they become disabled, they retire, they downsize, they lose jobs, they get promotions, right? But the extent that you carried it out, for how long, right? As if your intentions cannot change from day to day, year to year, decade to decade, okay?
Yeah, I mean, like, who's the person who's going to be determining this? And when you give this, what my intention was to purchase this property, who's the one who makes the decision on the other side that you're lying or you're not being truthful? You're going to have some, mid-level bureaucrat who's going to be making the decision on the other side at the CRA.
Yeah.
Just like you said just a minute ago, like, life changes, things happen, people die, people get divorced, people get sick, lose their jobs. Like, it's kind of insane. The list that you're going through. Well, what was your intention? Like, you're already, having to prove your innocence, it seems like, rather than, them just taking it at face value. But yeah, continue on with this list. I can't wait to hear the rest.
The evidence that the taxpayer's intention changed after the purchase of the real estate. In this circumstance, I'm going to tell you something about in this circumstance. In this circumstance, the client had a child. They did not ask that, okay? The client had a child, determined that this property was not for their best purposes, and they want to move to a different house. They attempted to renovate the house, realized that there was poor build quality in the house, realized it wasn't going to work with the new baby, and decided to move on from the house. Like, that's what happened in this scenario. Client held the house for longer than a year, even though that 1-year rule wasn't in place at the time that this was done. And the time that this was done was interesting too, because this is a very recent audit. This is from 2022. So they're taking stuff off the shelf right now to come and find these. So don't think because you sold 2 years ago or something that you're in the clear. They're taking stuff off the shelf and going looking for this. We've known this for some time. We can see it even in the tax software that is regularly distributed to accountants. You can see warning messages on, if you rent out your property, for example, that might jeopardize your principal residence exemption in the future. And my question is, like, since when does CRA start communicating tax risks through tax software by Intuit? We've known that this is coming. They're broke. and they're looking for capital, and where are they going to find it? They're going to find it in your, in your principal residence. As Trevor, as you said, a lot of our economy is based on selling houses back and forth to each other at ever increasing prices, and that's where a lot of the wealth is trapped.
Well, my question on this matter is, like, are they actually retroactively going back to try and recoup some so-called capital gains from this client? Or are they like what's the details on this? Because it sounds kind of fishy to me.
Here's not only are they going back, Trevor, not only are they going back to 2022, okay? In 2025, they're sending this request relating to 22. Not only are they going back, they're not going to say it's a capital gain. They want to say it's business income. They don't want to tax on 50% of the gain. They want to tax on 100% of the gain as if it was an inventory purchase that you sold for gain, okay? And I'll give a little more background, but I'll go through the entire list before we see it, okay? The nature of the business, profession, calling, or trade of the Taxpayers Association. So, if you're a realtor, look out. If you're someone who works in trades and you know how to improve property, look out. If you're someone who knows how to get mortgages, look out. Okay? Just the industry that you work on, they are going to discriminate on if you should be able to use your principal residence exemption or not. Just the industry that you work on. And it gets worse. It gets much worse. Okay? The extent to which you borrowed money was used to finance the real estate acquisition and the terms of the financing, if any, arranged. So if you needed to borrow money to buy a house, if you did not buy it in cash, fully in cash, maybe we don't want to give you your principal residence exemption. If you decided that rates were too high when you bought in the last year, and you said, I'm just going to lock in for a year or two. Well, obviously that must mean that you bought this for business purposes and you plan to sell it at the end of the year. So how many Canadians, Trevor, are buying houses in cash?
No, besides the ultra wealthy and not cartels, very, very few. I think almost everybody has a mortgage on their property, especially first-time home buyers, and people who are trading up above the property ladder, so to speak, going from a condo to a single-family home to a larger single-family home or what have you. People are getting mortgages. Mm-hmm. It's just tougher to get one than it used to be.
And then it's the length of time throughout which the real estate was held by the taxpayer. So the length of time. So people hear the 1-year rule and they're like, well, it's good. I held it for a year. It's fine. It's like, no, that's just another hurdle. It's not the hurdle. It's just they're definitely going to disallow you if it was 11 months. Like 100% of the time they're going to disallow it if it's 11 months. But it's the length of time. So is 13 months good enough? In this case, was a year and a half good enough? Was not good enough. It was not good enough, okay? And the existence of persons other than the taxpayer who share interest in the real estate. So not just if you're a realtor or you work in trades or you work in financing, what does your spouse do? Okay, level beyond that. How many people get gifts or have co-signers in mortgages in Canada? Okay, so they get their mom or dad to co-signer on that. What do they do as a profession? Are they in real estate? Are they in trades? Are they in financing? They want to disallow your principal residence exemption for that. Okay, so people are saying, it's like, well, we don't want to lose your principal residence exemption. It's like, guess what? You're already losing it. Administratively, they're already starting to block this. Okay. The nature of the occupation of the other persons referred to in I above, as well as their stated intentions and courses of conduct. Okay, so if someone lent you some money, if someone lent you some money, so we already talked about what their profession is, that other person, but if they lent you some money, what was their intentions? Well, most of the time when people lend money, it's to make a rate of return. Inherently, it's to make a rate of return. That's the goal of it, right? And so what that in itself, the intentions of the other person on the title, that can block your principal residence exemption, okay? Factors which motivated the sale of the real estate. I want to focus on those factors that motivated the sale. Because this one, when you think about it, it's absurd. It's like in this case, the client sold because it wasn't going to work for their growing family. They weren't when they started to renovate it. They weren't totally happy with the build quality and felt that they couldn't really complete the renovations to any standard that would accommodate their family moving forward. But like, why do people normally sell real estate? Normally, people sell real estate to realize a gain. I mean, the whole term starter home, it's to get into the property market, to get a bit of equity, hopefully get a bit of appreciation, and sell it someday to move on. But that in itself, CRA wants to say it makes you ineligible to use your principal residence exemption. So, I mean, the only reason you could use your principal residence exemption is because you have to move away for a job or you die, I guess. That's the, because if the factors that motivated the sale, if your price had gone up and you sell because the price has gone up, well, hey, you sold because the price went up, so obviously we should tax you on that. I mean, this is the absurdity that CRA is using. This isn't my speculation. This is actually what's on the CRA audit documents that, we've received, okay? And then the evidence that the taxpayer and or associates had dealt extensively in real estate. Okay, so let's say you're building a real estate portfolio. Okay, as this client was, he was building a real estate portfolio, and you're paying tax on those gains. You're paying rental income on those gains, and you still need a place to live for yourself. And so think about like everyone, how many people own a rental property in Canada? It's like, that's a common thing. Owning a rental property is fairly common. But that in itself, they could say, well, you've had, 2 properties and one of them was used exclusively for income. So obviously this one was used exclusively for income too. Like, this is the absurdity and vagueness of this, that basically you could rule with these criteria that you could make the absurd argument that virtually any disposition of real estate in Canada is taxable. And like I said, they're not just saying it's a capital gain. They're saying that it's business income. So not taxed on 50% of the gain, taxed on 100% of the gain, directly in income, retroactively 3 years back. Okay. So in this case, the client was a realtor. But like, I know the guy. He legitimately bought this property to be his principal residence and just started renovating it, had a kid, and they started renovating it, and then they just found something else that they liked better. So they got rid of it. This was not part of his real estate portfolio. And here's the kicker. This guy has never flipped a house in his life. He's a realtor, and he's bought rental properties to derive income. He's never flipped a house. He's never bought a house with the intention to sell it quickly. He's only bought real estate with the intention to generate rental income from it for long periods of time. It's not even in the history of his transactions with real estate. This would be the first time he's ever done anything like this. Okay. And so that's the thanks for, generating rental income and generating other taxable capital gains that he's paid tax on and paying the tax diligently and working. God forbid you work in an industry that pays you. And that precludes you from using your principal residence exemption. Okay. So I caution people, the big one, it's like, I caution you, it's like a lot of equity is tied up in your principal residence, and that's a lot of Canadians. And I tell people, it's like, hey, there's like 5 buckets that you could put wealth in. Okay, we know that the fake money depreciates. We know we got to get the fake money into real assets. Okay, but real estate is just one. Real estate is just one asset. And we're lying to ourselves if you can simply put assets on a spreadsheet and pick the best rate of return, because that assumes that the rules that the government will put on those assets remain the same year to year, decade to decade. They change, okay? So the way you diversify outside of that risk, so you understand is that real estate is just one bucket. There are private businesses, there are cash flow producing stocks, there are gold, and there are Bitcoin. And I'm telling people, I am telling you, when people tell me that, well, Bitcoin is risky, it's like, this is risky. This is risky, that your principal residence exemption, that they want half of that thing. Now what's that rate of return? Compare that to, how you just compare that to how gold appreciates. Just lumps of gold are appreciating at 10% and have been for probably almost 3 decades now. 3 decades that you could have just bought a lump of gold and this thing would go up by 10%. Okay. And so we have to start evaluating the risk, and you have to understand, it's like, in this case, we're going to fight this. Okay. This is the first step in the objective, where we get an audit and they send out first of all, they make a ruling without any information, and then they ask for information, and then they basically just, they ask for limited information, and then they make a ruling based on the limited information that they asked for, which naturally goes in their favor. And you'll see, Trevor, you said something interesting. It's like, you said, who's making this ruling? Well, someone, a bureaucrat who has a key performance indicator, and one of them is how much tax do they collect from these activities? So they're intrinsically motivated to rule in favor of CRA because it makes their stats look better. Okay, I went out and collected this tax revenue, so why would they do it fairly, right? And so, in this case, the next step in the process is we've already objected to the assessment, and then we'll go through the objection process. Anyone want to guess how long the objection process is that we're going to go through?
Oh man, probably 6 to 12 months.
18 months. Told the client, par for the course.
18
months. Like hopefully in 90 days, they'll write us back saying they received our objection. And then they'll probably advise on the timelines, and a lot of those objection timelines, usually 18 months. Okay. This guy's going to sit there, and you kind of got 2 options when you do it. Like, once we get it under formal objection, they're going to stop any collection action on it, but the interest still accrues. So the interest accrues, right? And of course, if the interest accrues and you end up having to pay CRA, they charge you a higher rate of interest. But if they owe you, they'll pay you a lower rate of interest. So it's not even a fair game there, okay? And so what will be the process there? Hopefully will be will be successful in the objection process, because then you get in front of someone whose KPI is not how much tax I collected. The person who sent this out from CRA, they have their key performance indicators. How much tax revenue did you receive from this process? The person at the objection department, hopefully their KPI is how many of these objections do they process. So a little bit different motivation. And then what goes beyond that? Is then the client has to hire a lawyer to sue the government in tax court. And I think we would in this case. In this case, it's so egregious because the guy actually bought. I know this guy bought. I've known him for years. He bought this to be his principal residence. Like I said, has never actually bought real estate to flip. Has only ever bought real estate to buy, hold, and earn rental income for. And this property that he bought is nothing like the properties he buys to rent out. Nothing like it. It lacks the number of doors. It's the wrong neighborhood. It's the wrong price point. Like, he's a sophisticated investor. He wouldn't have bought this to generate rental income because it wouldn't have been the best purchase to do so. Okay, and boy, is he pissed. He's pissed. I mean, I get the emotional reaction from them, and he understands what it is, and he's like, what he says to me is like, what if I just leave? Josh, what does that look like? If I just take all my wealth and convert it to Bitcoin and I leave, what does that look like for me? I was like,
right?
I don't think that's the first step in this process. That's like the emotional reaction, and I don't think that'll be this guy's reaction at the end, but I think it will be someone's reaction. Imagine you have your entire net worth tied up in $1 million house, and you did really well. You hold it for bunch of years, you had it, maybe it's worth 1.25 million. You bought it for 250,000. That's your entire baby. And then, you got $1 million gain, and then now the government wants half plus penalties plus interest. Someone's leaving. Someone is going to take that capital on a ledger, go to the airport, and say, see you later. Like that is going to happen. I don't think our tax authorities are quite primed for this, because there's a point where you get so far where the motivation stops being to be a good citizen, right? I tell people it's like the Laffer curve of taxes. Okay, at 0%, everyone would comply. At 100% tax rate, everyone would cheat. Like that's it, because what's the point? You'd be broke anyways, right? You're going to zero.
Well, it's getting there. It's getting there, Josh. I mean, when it comes to taxes, like the average worker gets taxed 43% of their income, okay, average Canadian citizen, plus everything you buy, plus gas tax, fuel tax, GST tax, and then now they're coming after your principal residence. What's the benefit of living in Canada? What's the benefit of generating wealth in Canada? So I think people, should pay attention to this. And if you are getting into the market, diversify. Like you mentioned, there's 5 other ways that you can create wealth, 5 other buckets you can make money on. Start getting into those other buckets, because, real estate used to be a stronghold, a safety, a bastion to create and accumulate wealth over time. But now it's questionable.
Yeah, and I'm not an advocate of no real estate. I own a lot of real estate. I haven't sold any real estate, but I stopped buying real estate in 2022. I stopped. Like, I haven't bought any more real estate. I have zero plans to buy more real estate. Even the development property that we have, that our corporation owns, is like, do I want to develop it? I've second guessed it at this point, right? I've been fighting with the city of Edmonton, who doesn't want me to use my own land for the purposes that are specifically outlined in the neighborhood structure plan. So we'll keep fighting on that. Just got a notice the other day that they want to defer the hearing until January. So that'll be fun. But this is what's involved for real estate investing. It's like, if you're in real estate investing, I mean, you can pretty much expect some form of audit or litigation or quasi-litigation with the government. Like that is what's involved in this business, right? So people are going to make decisions based on that and how efficient of a use is that, right? So hopefully that's kind of helpful for someone. It's like, it's not the reason to not buy real estate. But it should be the reason to say that this is why you shouldn't have 100% of your net worth in real estate. You should not have 100% of your net worth in real estate, because that in itself is a risk, okay? It is largely the easiest asset for the government to tax, seize, freeze. Like, it is very easy. It's illiquid. It's hard to transact. Even a brokerage account. You can sell it tomorrow, have the cash in your bank account, and send it where you want, theoretically. That's getting a little harder these days, but it's still more liquid than real estate. Okay, so it leaves you susceptible to this. So you have to understand that this is coming, and you have to understand that the rules in place, when you start hearing like 1 year, it's like, that is like the very first hurdle of not paying tax on your principal residence. It's not a silver bullet at all. It's not even close. It's just an extra hurdle. It'd be great if they publish crystal clear black and white rules, but that's just a black and white rule in their favor. It's just it's a way that they can strip you of your principal residence 100% of the time, but just because you cross that threshold doesn't mean it protects you at all. And so people have to understand that they probably should be more conservative approach in their ability to use their principal residence, and expect that as the years go by, as the decades go by, their ability to use it will become more and more restricted, okay? And the motivation to hold different types of assets will become bigger and bigger, okay? So hopefully that's, yeah, go ahead, Trevor.
I said, wow, that's incredible. More and more people should realize that you got to diversify. You got to do something else. And I'm just glad that we've been telling people for years, what to do, and helping them with strategies to protect themselves, to get them prepared for other circumstances, and to put money in those other buckets. So if somebody is in a situation where they have a lot of their holdings in real estate, or if they're looking for other ways to invest and grow wealth, get a ticket to the boot camp. Come and see the boot camp. The next one's in November. Josh, you have the specific date there?
Yeah, I believe it's November 8th on the website. November 8th, Saturday, Edmonton and West Edmonton Mall. No, and we're not doing it in your city. Like, if you won't get on a plane and come see it, like, it's going to fill up. So we know all the serious people in the country fly around to see it. It's one of the best atmospheres that you'll be in. People starting out, multimillionaires who flew in from across the country. So, yeah, get a ticket to the boot camp. We'll show you how to extract that equity from a principal residence and diversify into other asset classes. So, hopefully that's helpful for someone. Thanks for tuning in. Like and subscribe, and we'll see you back here next Friday. Trevor, we'll both be in the studio for first time in a while.
All right, we'll see you then.
See you then. Okay, bye-bye.